Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. For most Australians trying to build wealth, there are really two broad environments in which we invest. There's superannuation, which is wonderfully tax effective, but comes with contribution limits and restrictions on when we can access our money. And then there's everything outside super. For a long time, when investing outside super, the tax system has provided a fairly significant incentive to own growth assets personally or perhaps through a family trust. Hold an investment for more than 12 months, make a capital gain, and broadly speaking, only half of that gain is included in your taxable income. But from the 1st of July 2027, that landscape changes considerably. The federal government is replacing the 50% capital gains tax discount with an indexation system. Instead of simply halving your capital gain, you'll adjust your cost base for inflation and then pay tax on the real gain. Importantly, there'll also be a minimum tax rate of 30% on real capital gains. Now, for assets you already own, there's grandfathering. Gains accrued before the 1st of July 2027 retain the existing treatment. This is only for gains accruing after that date. They will fall under the new system. This 30% minimum tax change potentially alters the relative attractiveness of some investment structures that, until now, have tended to sit on the fringes. One of those is the investment bond, often also known as an insurance bond, which is more technically correct. And that's what we're going to dive into in today's episode. All right, well, thanks for joining me once again. Let's dig in. Okay, well, let's start with what exactly is an investment bond. Now, despite its name, an investment bond isn't really a bond in the conventional investment sense. You're not necessarily investing in fixed interest, which is what a bond normally suggests. An investment bond is better thought of as a tax structure or an investment wrapper, you sometimes see it referred to. Within that structure, you can typically invest in a range of assets: Australian shares, international shares, property securities, fixed interest, and diversified portfolios. The important distinction is how the investment is taxed. Rather than investment earnings being distributed to you each year and included in your personal tax, tax is paid within the investment bond structure, exactly the same as happens in your super fund. The headline tax rate within an investment bond is 30%. But importantly, that doesn't necessarily mean the actual tax paid is 30%. Depending on the investments held, there's deductions, there's franking credits, there might be foreign tax credits too. So that can often reduce the effective tax rate below that sort of headline 30% level. Now, of course, if you own the investments in your own name, you'd also be claiming those credits. So, swings and roundabouts on that. But for someone paying the top marginal tax rate particularly, you've potentially created a significantly lower tax environment in which to compound wealth. Until now, however, investment bonds have had to compete with the very generous 50% capital gains tax discount available to individuals and trusts. And that's often made the comparison, not so compelling. But the new tax regime with this minimum 30% tax, all of a sudden, it changes the equation quite significantly. Investment bonds, again, very similar to superannuation. For them to be useful and valuable, they're really about long-term investment and compounding. So the interesting thing about investment bonds isn't just the tax rate. It's also when you pay the tax and how much administration is created along the way. So imagine you're building a portfolio outside of super and you've got some Australian share exposure, some international share exposure, perhaps some different funds as well. Over time, there's distributions, there's dividends, capital gains, and you might make some portfolio changes too. And these all create personal tax consequences, right? You've got to include them in your personal tax return. If you're using a managed fund, it could even be that because of changes that the fund manager makes, you might get a taxable capital gain distribution, even though actually you never personally sold anything. Well, an investment bond works differently. Tax is dealt with internally. You don't generally receive annual taxable distributions that need to be included in your personal tax return. You can also switch between investment options within the bond without personally triggering capital gains tax whenever you make a change. So that potentially creates a very useful long-term compounding environment. And after an investment bond has been held for 10 years, withdrawals can generally be made without additional personal tax being due. Now, there are rules around this, and one of which is the 125% rule, which governs additional contributions. So investment bonds aren't something you simply throw money into without understanding the structure, right? There is a little bit of nuance here. But for genuinely long-term money, they're worth getting your head around. Now, just a quick sidebar here. I sometimes see reference to the 10-year rule with regards investment bonds presented as being tax-free after 10 years, right? Now, that's false. Within the investment bond, tax continues to be paid beyond that 10-year period at the normal 30% rate. The only change at the 10-year point is that when you withdraw, there's no top-up tax that you need to pay. Instead, any withdrawal is treated as having been fully tax paid. Now, there's swings and roundabouts on this, right? Because significantly, if your tax rate was less than 30%, let's say because you're retired and you're paying no tax at all, there's also no tax refund for any excess tax paid, right? It's just you withdraw, you've had it more than 10 years, you haven't breached the 125% rule, so therefore when you withdraw, it's just the tax is done. There's no further tax consequence. There's nothing for you to pay. There's no refund. It's done. Okay, so where might investment bonds fit? The first obvious application is what I think of as superannuation overflow. Right? Super remains extraordinarily attractive. If you're eligible to contribute to super and you're comfortable locking your money away until you satisfy a condition of release, it'll continue to be your first port of call. But eventually you run into limits. There's the contribution caps, there's the total super balance restrictions, and there's the transfer balance cap. And on top of that, sometimes you just don't want your money locked up until you're at least 60. And that's where investment bonds come into play. Historically, you might have simply held an investment portfolio you own personally, jointly with a spouse or through a family trust. And that might still be appropriate for a lot of people, but investment bonds now need to be part of the conversation. Family trusts certainly aren't going away. They can provide asset protection, flexibility, and the ability to distribute income amongst family members. For business owners in particular, they can serve purposes that an investment bond is never going to replicate. But if the primary reason for establishing or maintaining a trust is simply to create a tax-effective pool of long-term family investments, the comparison may become much closer. There's also the administrative side. A trust typically means a tax return, accounting costs, resolutions, ongoing compliance and paperwork. Whereas an investment bond is much simpler from an investor perspective because the bond just handles everything. They pay all the tax. There's really nothing you need to do. And that simplicity, that holds real value. Estate planning is another interesting element of investment bonds. So I mentioned earlier that technically these products are actually insurance bonds. Somewhere along the journey, the marketing departments decided that renaming them investment bonds was a far easier sale. With these bonds, you can nominate beneficiaries, and depending upon how the bond is structured, proceeds can be paid directly following death rather than forming part of your estate. That can make them useful where someone wants a particular pool of money to pass to a particular person. As an example, if you had children from a first marriage and you wanted to ensure that whilst your new spouse will get your super and the house, your children will get your investment assets, you could nominate them as beneficiaries of the bond, and that would get paid on your death, irrespective of what your will says. So, in other words, any sort of challenge to the will, or even, potentially if your new spouse was younger than you and outlived you, they could always change the will after you're gone. None of that would matter, because if you've got an insurance bond, it has your kids nominated as the beneficiaries, then, as I say, it's actually an insurance contract. So when you die, it gets paid to the nominated beneficiaries. It never forms part of your estate. The will has no bearing. So it certainly gives you some great certainty there. They can also be useful when investing for children or grandchildren. So let's say you wanted to set aside $50,000 today for a grandchild who's currently 5 years old, with the intention that they'll ultimately receive the money when they're 25. An investment bond gives you a structure in which that money can compound over a long period, with the tax handled internally and with some control over how ownership eventually passes. And significantly, when the money passes to your grandchild, vesting is the jargon term, there's no capital gains event. They just become the owner of the bond at that nominated point. Now, this isn't to say that, investment bonds are always the answer, right? None of this means everyone should automatically sort of rush out and buy an investment bond. The investment options matter, as do the fees. The 10-year rule matters. And weirdly, and it's too complicated to dive into today, actually there can be instances where withdrawing at the 8th or 9th year actually gives you a better outcome than hanging out for the 10th year. An understanding of the 125% contribution rule is important, and their effectiveness also hinges on your marginal tax rate. So if your personal tax rate is less than 30%, then using investment bonds could actually make you worse off. We're entering a world where 30% tax is the new norm. Look, some people will pay more, but not very many people will pay less. Superannuation remains the most attractive investment vehicle there is, but as mentioned at the top, it's not right for every circumstance. In this new environment, a structure that offers internally taxed compounding, no personal tax consequences from portfolio switching, potentially tax-paid withdrawals after 10 years, so long as you don't screw up the 125% rule, and some useful estate planning flexibility starts to look considerably more interesting. Investment bonds won't replace superannuation. They won't replace family trusts either, although I suspect they'll get used a lot less post-2028. And they certainly won't be right for everybody. But for long-term wealth that needs to sit outside super, they're about to become much more important as part of the financial planning toolkit. And certainly, they're worth you knowing about. All right, well, look, thanks for listening to another episode. Of course, Nick will be back with Wealth Builder next week, and I'll be back with another Financial Autonomy episode in a fortnight's time. Make sure you're getting our Gaining Choice email newsletter so you know what's going on with markets, and most importantly, so you can see how smart you are with our quiz. If you're not getting Gaining Choice yet, there should be a link in the show notes for you to do that. Also, if you go to our website, there'll be a link somewhere where you can do that too. Depending on which platform you're consuming this podcast on, but there's a good chance that there's the ability to leave some comments. So we'd love you to do that. It's always good to get a bit of feedback. But otherwise, look, thanks for listening. I'll sign off for now, and I'll be back in a fortnight's time. Bye-bye.